All right, listen up. Before you even think about hitting that buy button, you've got to do your homework. I'm yelling this because it's the most important rule in the book. So many people get wiped out because they treat the stock market like a casino in Vegas. They hear a hot tip from their brother-in-law, see some talking head screaming on TV, maybe even me, and they throw their hard-earned money at a stock they know nothing about. That's not investing, that's gambling. And the house always wins when you gamble. Your first job, your only job at the beginning, is to become an informed investor. You wouldn't buy a house without an inspection, right? You wouldn't buy a car without a test drive. Why on earth would you buy a piece of a company without doing the same level of due diligence? It's your money on the line. The goal of your research is simple: to understand what you own. You need to know that company inside and out. What do they sell? Who are their customers? Who are they fighting against for every dollar? You need to develop a conviction, a rock-solid belief in why this company is going to make you money over the long haul. This isn't about what the stock price did yesterday or what it might do tomorrow. This is about understanding the business itself. Is it a leader in its industry? Does it have a secret sauce that nobody else can replicate? Answering these questions is what separates the pros from the amateurs, the winners from the losers. Don't be lazy. The money you save by avoiding one bad decision will be worth every single hour you spend digging through the details. Think of yourself as a detective. You're looking for clues that point to a company's future success. Start with the company's own website. Read their annual report, specifically the letter to shareholders from the CEO. Does the CEO sound like a straight shooter or a carnival barker? Are they honest about their challenges, or do they just pump sunshine? Then, you need to broaden your search. Look at what their competitors are doing. Read articles from reputable financial news sources. Understand the industry landscape. Is this a growing industry, or is it getting crushed by new technology? Your homework is your shield. It protects you from panic selling during a market downturn and from getting suckered into the latest fad stock that's destined to crash and burn. So let's make a pact right here, right now. No more blind investing. No more buying on a whim. From this day forward, you are a student of the market. You are a financial detective. You will put in the work because you respect your own money. You will turn off the noise and focus on the fundamentals. This is the foundation upon which all successful investing is built. Get this part right, and you're already halfway to the winner's circle. Ignore it, and you might as well just set your money on fire. The choice is yours, but I know you're going to make the smart one. Now let's get to work. Booyah! Now that you're committed to doing your homework, let's talk about the good stuff. The intangible factors that don't always show up on a spreadsheet but can make or break a company. First up is the moat. Think of a medieval castle surrounded by a giant ditch filled with water. That moat protected the castle from invaders. In the business world, a moat is a company's sustainable competitive advantage. It's that special something that protects it from competitors trying to steal its profits. It could be a powerful brand name like Coca-Cola or Apple that people trust and will pay extra for. It's what makes you choose one product over another, even if they seem similar. A moat can also come from other sources. Think about patents that protect a drug company's blockbuster medicine for years, or network effects, where a service becomes more valuable as more people use it. Think Facebook or Amazon. The more sellers Amazon gets, the more buyers it attracts, and vice versa. That's a powerful, self-reinforcing moat. Another one is high switching costs. Is it a huge pain for a customer to switch to a competitor? Your bank, for example. Moving all your automatic payments and direct deposits is a nightmare, so you probably stick with them. These moats are the secret sauce. They give a company pricing power and ensure its profitability for years, even decades. A company with a wide moat is a fortress of finance. Next, you have to look at the generals leading the army, the management team. Are they shareholder-friendly? Do they have a clear vision for the future, or are they just trying to line their own pockets? A great CEO is worth their weight in gold. They are the captain of the ship, steering it through calm seas and stormy weather. You want to see a management team that has skin in the game, meaning they own a lot of the company's stock themselves. When their wealth is tied to the company's success, you can bet they're going to work their tails off to make that stock price go up. Listen to their conference calls. Are they transparent and confident, or are they evasive and full of excuses? Bad management can run even a great company into the ground. Finally, you need to ask if this company is riding a powerful, long-term trend, what I call a mega trend. Think about the shift to cloud computing, the rise of artificial intelligence, or the global transition to clean energy. These are not fads. They are massive multi-decade shifts that are changing the way we live and work. A company that is perfectly positioned to benefit from one of these megatrends has a powerful tailwind at its back. It's like a surfer catching a giant wave. Even a decent company can look like a superstar when it's riding a megatrend. Finding a great company with a wide moat and top-notch management that is also riding a powerful megatrend, that's the trifecta. That's how you find the stocks that can change your life. All right, you've sized up the moat and the management. Now it's time to get your hands dirty and look under the hood at the company's financials. Don't be scared by the numbers. This is easier than you think. The first thing I always check is the balance sheet, and I'm looking for one thing in particular: debt. Debt can be a killer. A company loaded with too much debt is like a swimmer trying to cross the ocean with an anchor tied to their leg. In good times, it might be manageable. But when a recession hits or business slows down, that debt can become a noose that chokes the life out of the company. You want to find companies with strong balance sheets, more cash and assets than liabilities and debt. A fortress balance sheet gives a company flexibility to survive tough times and invest for future growth. Next, we move from the balance sheet to the income statement to look for profits. Is the company actually making money? And more importantly, is that profit growing over time? I want to see a consistent history of rising revenue, which is sales, and rising net income, which is profit. A company that can't grow its sales is a company that's standing still. And in this market, if you're standing still, you're getting run over. Look for a steady upward trend over the last 3 to 5 years. One great quarter is nice, but it could be a fluke. A consistent pattern of growth tells you that the company's products are in demand and that management knows how to run the business efficiently. Profit is the name of the game, people. It's the fuel that powers stock price appreciation. Now let's put it together with some simple ratios. Ratios help you compare companies of different sizes and see how they stack up. One of my favorites is the debt-to-equity ratio. It tells you how much debt a company is using to finance its assets compared to the amount of its own money it's using. A ratio below 1 is generally good. It means the company has more equity than debt. Another key metric is the profit margin. This tells you what percentage of every dollar in sales the company keeps as profit. A higher profit margin is better. It's a sign of a strong business with a good moat that doesn't have to slash prices to compete. Comparing the profit margin of your company to its direct competitors can be very revealing. Finally, let's look at return on equity, or ROE. This ratio measures how efficiently a company is using its shareholders' money to generate profits. Think of it this way: if you give the CEO $1, how many cents of profit can they generate with it in a year? A consistently high ROE, say above 15%, is often the hallmark of a superior business. It shows that management is excellent at allocating capital and creating value. Don't get bogged down in dozens of complicated metrics. Start with these basics. Check for low debt, look for growing profits, and use simple ratios like profit margin and ROE to gauge the quality of the business. This financial checkup will help you avoid the sick puppies and find the thoroughbreds. So you found a fantastic company. It has a huge moat, great management, and the financials look pristine. Now comes the million-dollar question: what price should you pay for it? Buying a great company at a terrible price can lead to a terrible investment. This is where valuation comes in. Valuation is the art and science of figuring out what a company is truly worth. There are many ways to do it, but let's focus on two simple approaches. The first is called relative valuation. This is where you compare the company's stock to its own history and to its competitors. It's like shopping for a house and looking at what similar houses in the neighborhood have sold for. It gives you context. The most common tool for relative valuation is the price to earnings, or PE ratio. This ratio tells you how much investors are willing to pay for each dollar of the company's earnings. A PE of 20 means you are paying $20 for every $1 of annual profit. You can compare a company's current PE to its average PE over the last 5 years. If it's significantly higher, the stock might be expensive. If it's lower, it could be a bargain. You also need to compare its PE to its direct competitors. If your company trades at a PE of 15 and its main rival trades at 30, you need to ask why. Maybe your company is a better value, or maybe the rival has much better growth prospects. The PE ratio isn't perfect, but it's a great starting point for framing the price. The second major approach is a bit more advanced, but is the way the pros think. It's called discounted cash flow, or DCF. Don't let the name scare you. The concept is simple. A company is worth the sum of all the cash it's going to generate in the future, discounted back to what it's worth today. $1 tomorrow is worth less than $1 today. Right? DCF analysis tries to forecast a company's future cash flows for the next 5 or 10 years, and then discounts them to find their present value. This gives you an estimate of the company's intrinsic value. If the current stock price is well below that intrinsic value, you've found a potential winner. Now, DCF is tricky because it requires you to make assumptions about the future, and nobody has a crystal ball. But the exercise itself is incredibly valuable. It forces you to think critically about the company's long-term growth prospects and profitability. You don't need to build a complex spreadsheet model yourself. Many financial websites provide analyst estimates for future earnings and cash flows that you can use as a starting point. The key takeaway is to have a rational basis for the price you're willing to pay. Whether you're using simple PE ratios or thinking about future cash flows, the goal is the same: to buy a great business at a fair price. Don't just chase a stock that's going up. Anchor your decision in a thoughtful assessment of its value. You've done the homework, checked the financials, and determined a fair price. It's time for action. It's time to buy the stock. The first thing you'll need to do is fund your brokerage account. Then you'll go to the trade or order screen. You'll enter the stock's ticker symbol, the unique code that represents it on the stock exchange, like AAPL for Apple or AMZN for Amazon. Then you need to decide how many shares you want to buy. But the most important decision you'll make on this screen is the order type. This tells your broker you want to buy the shares, and it can save you a lot of grief. Let's break down the main types. The simplest and most common order is the market order. When you place a market order, you're telling your broker, "Buy me these shares right now at the best available price." It's fast and almost always gets executed immediately. The downside? You don't have control over the exact price you pay. If the stock is moving quickly, the price you end up paying could be higher than what you saw just a second ago. For a big stable company, the difference is usually pennies. But for a smaller, more volatile stock, a market order can be dangerous. I rarely recommend using a market order. You're a smart investor, and smart investors want control. This brings us to the limit order, the preferred choice of the pros. A limit order lets you set the maximum price you're willing to pay for a stock. For example, if a stock is trading at $50.25, you can place a limit order to buy it at $50. Your order will only execute if the price drops to $50 or lower. This gives you complete control over your entry price. You'll never overpay. The only drawback is that if the stock never drops to your limit price, your order won't get filled, and you might miss out. But that's a risk worth taking. It's better to miss out on a stock than to chase it and pay too much. Discipline is everything. Finally, let's talk about an order you'll use when you sell: the stop-loss order. This is your safety net. A stop-loss order is an instruction to sell a stock if it falls to a certain price. For example, if you bought a stock at $50, you might place a stop-loss order at $45. If the stock price drops to $45, your order automatically becomes a market order to sell, limiting your loss to 10%. This is crucial for risk management. It takes the emotion out of the decision to sell and protects you from a catastrophic loss if a stock suddenly plummets. Knowing how to use these different order types, market, limit, and stop loss, is fundamental to executing your strategy like a professional. I'm going to be loud and clear on this one. You have to watch out for the costs. They're like termites, silently eating away at your returns over time. Even small-sounding fees can add up to a mountain of money over your investing lifetime. The first and most obvious cost used to be trading commissions. This is the fee your broker charged every time you bought or sold a stock. Thankfully, in today's world, most major online brokers have gone to zero commission trading for stocks and ETFs. This is a huge win for the individual investor, but don't let zero commission fool you into thinking trading is completely free. There are other little gremlins to watch out for. One of these is the bid-ask spread. When you look up a stock quote, you'll see two prices: the bid price, what buyers are willing to pay, and the ask price, what sellers are willing to take. The ask is always slightly higher than the bid. This tiny difference, the spread, is a hidden cost of trading. For large, heavily traded stocks, this spread is a fraction of a penny, no big deal. But for smaller, less liquid stocks, the spread can be much wider. When you buy at the higher ask price and could only immediately sell at the lower bid price, you've instantly lost a little bit of money. It's one more reason to stick with limit orders to control your price. Then there are all the potential fees if you invest in mutual funds or exchange-traded funds, ETFs. The big one here is the expense ratio. This is an annual fee expressed as a percentage of your investment that the fund charges to cover its operating costs, things like portfolio management, administration, and marketing. An expense ratio of 1% might not sound like much, but it means that for every $10,000 you have invested, you're paying $100 in fees every single year, whether the fund makes money or not. Over 30 years, that can consume a massive chunk of your potential gains. Always look for low-cost index funds and ETFs with expense ratios well below 0.2%. Last but certainly not least, we have the taxman. Uncle Sam always wants his cut. When you sell a stock for a profit, that profit is called a capital gain, and it's taxable. The amount of tax you pay depends on how long you held the stock. If you held it for 1 year or less, it's a short-term capital gain and is taxed at your ordinary income tax rate, which can be quite high. But if you held the stock for more than a year, it's a long-term capital gain, and it's taxed at a much lower rate. This is a huge incentive to be a long-term investor, not a frantic trader. Understanding these costs, commissions, spreads, expense ratios, and taxes is critical. Minimizing them is one of the easiest ways to boost your net returns. Let's take a step back and make sure we've got the absolute basics down cold. What even is a stock? When you buy a stock, you are not just buying a piece of paper or a ticker symbol on a screen. You are buying a small piece of ownership in a real business. You are becoming a part owner of that company. If you buy 1 share of Apple, you own a tiny fraction of its factories, its patents, its brand, and its future profits. As an owner, you have a claim on the company's assets and earnings. If the company does well and becomes more profitable, your share of the business becomes more valuable and the stock price goes up. That's the whole point. Thinking like an owner, not a ticket holder, is a complete game changer. So how do you actually buy these shares? You can't just call up the CEO of Ford and say, "I'll take 10 shares, please." You need to go through a licensed intermediary called a stockbroker. In the old days, this was a person in a suit you'd call on the phone. Today, it's almost always an online brokerage firm with a website and a mobile app, like Fidelity, Charles Schwab, or Robinhood. Your broker is your gateway to the stock market. They hold your money and your stocks in an account for you, and they execute your buy and sell orders on your behalf. Choosing a good, reputable, low-cost broker is one of the most important first steps you'll take on your investing journey. Where do these transactions happen? They take place on stock exchanges. Think of an exchange as a giant, organized marketplace where buyers and sellers of stocks come together to trade. The most famous exchanges in the United States are the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE is the older, more traditional exchange, home to many blue-chip industrial companies. The NASDAQ is the newer, all-electronic exchange, famous for being the home of many of the world's biggest technology companies. When you place an order with your broker, they route that order to one of these exchanges to find a seller if you're buying, or a buyer if you're selling, and complete the transaction. So let's put it all together. A stock represents ownership in a public company. You use a broker to get access to the stock exchanges, which are the marketplaces where stocks are traded. When you buy a stock, someone else is selling it. The price is determined by the constant ebb and flow of supply and demand for those shares on the exchange. It might seem complex, but at its core, it's just a system to facilitate the transfer of ownership in businesses. Understanding these fundamental building blocks is essential. It demystifies the process and empowers you to act with confidence instead of confusion. You're not just gambling on squiggly lines, you're participating in the engine of capitalism. It is absolutely crucial to understand the difference between investing and trading. They might both involve buying and selling stocks, but they are as different as night and day. Their goals, their time horizons, and their methods are polar opposites. An investor is in it for the long haul. They are buying a piece of a business that they believe will grow and become more valuable over many years, or even decades. They've done their homework on the company's fundamentals, its moat, its management, its financial health. They are business analysts. Their focus is on the long-term value of the underlying company, not the short-term blips in the stock price. An investor's mindset is that of a part owner. They're patient. When the market panics and stock prices fall, a true investor sees it as an opportunity to buy more of a great company at a discount. They aren't worried about the daily news cycle or the flavor of the month stock. They are planting an oak tree, not trying to grow a weed overnight. Their success is measured over years, not hours. Think of the legendary Warren Buffett. He's famous for saying his favorite holding period is forever. That's the investor mindset. It's a disciplined, patient, and business-focused approach. This is the path that has consistently built generational wealth. It's about time in the market, not timing the market. A trader, on the other hand, operates on a much shorter timeline. They could hold a stock for a few months, a few days, a few minutes, or even just a few seconds. Their goal is to profit from short-term price movements. They aren't necessarily concerned with the long-term fundamentals of the business. Instead, they rely heavily on technical analysis, studying charts, patterns, and trading volumes to predict where the stock price is headed next. They are trying to catch the waves of market sentiment. It's a high-stress, fast-paced game that requires constant attention. The trader is a sprinter. The investor is a marathon runner. Let me be clear. Trading is extremely difficult. It's a zero-sum game. For every trader who wins, another one has to lose. You're competing against sophisticated hedge funds with supercomputers and teams of PhDs. The odds are stacked against the individual. Frequent trading also racks up costs, from bid-ask spreads to higher taxes on short-term gains, which eat away at any potential profits. For the vast majority of people trying to build wealth for retirement or other long-term goals, investing is the far superior strategy. Don't confuse the two. We are here to be investors. We are here to buy wonderful businesses and hold them for the long term. Leave the frantic trading to the professionals and the gamblers. We're in the home stretch. You've learned the what, why, and how of investing. Now, let's etch these final golden rules into your brain. These are the strategic concepts that will keep you on the right path and protect you from your own worst enemy, yourself. The first and most important rule is diversification. Say it with me. Diversification. This is the only free lunch in investing. It means not putting all your eggs in one basket. No matter how much you love a single stock, you should never bet your entire future on it. Companies can fail. Industries can be disrupted. Unforeseen events happen. By spreading your money across many different non-correlated stocks in various sectors, you reduce your risk. If one stock blows up, it won't sink your entire portfolio. The second rule is to manage your risk. This goes hand in hand with diversification, but also involves your individual positions. Never invest more in a single stock than you are willing to lose. This is where position sizing comes in. A common rule of thumb is to not let any single stock become more than 5% of your total portfolio. This forces you to stay diversified and prevents one bad decision from wiping you out. It also means using tools like the stop-loss orders we talked about to define your downside before you even enter a trade. Hope is not a strategy. You need a plan to protect your capital. Your first job is not to make money, it's to not lose the money you have. The third, and perhaps toughest rule, is to control your emotions. Fear and greed are the two most powerful emotions that drive the market, and they are your mortal enemies. Greed will tempt you to chase hot stocks at absurd prices. Fear will tempt you to panic sell everything during a market crash, locking in your losses at the worst possible moment. The key to overcoming this is to have a plan before you invest. Write down why you're buying a stock and what would make you sell it. When the market gets crazy, go back to your plan. Trust your homework, not your gut. Turn off the noise, step away from the screen, and stick to your discipline. The investors who succeed are the ones who can stay calm when everyone else is freaking out. Finally, commit to being a lifelong learner. The market is constantly changing. New technologies emerge, new leaders rise, and old giants fall. The strategies that worked yesterday might not work tomorrow. The only way to stay ahead is to stay curious and keep learning. Read books, listen to podcasts, follow smart financial thinkers, and most importantly, learn from your own mistakes. Because you will make them. Everyone does. The difference between a successful investor and a failed one is that the successful investor learns from every mistake and uses it to become better. Your journey doesn't end when you buy your first stock, it's just beginning. Patience, discipline, and a relentless desire to learn are the keys to growing not just your wealth, but your wisdom as an investor. Now go out there and make some money. Booyah!